ಗುಡ್ ಮಾರ್ನಿಂಗ್ ಟು ಈಚ್ ಒನ್ ಆಫ್ ಯು. ಇವತ್ತಿನ ದಿವಸ ವಾಣಿಜ್ಯ ವಿಭಾಗದ ಪ್ರಥಮ ವರ್ಷದ ವಿದ್ಯಾರ್ಥಿಗಳನ್ನು ಸ್ವಾಗತಿಸುತ್ತಾ, ಇವತ್ತು ನಾನು ಅಕೌಂಟೆನ್ಸಿ ಮೂರನೇ ಅಧ್ಯಾಯ ರೆಕಾರ್ಡಿಂಗ್ ಆಫ್ ಬಿಸ್ನೆಸ್ ಟ್ರಾನ್ಸಾಕ್ಷನ್ಸ್ ಪಾರ್ಟ್ 1 ಬಗ್ಗೆ ನಾವು ಇವತ್ತು ಚರ್ಚೆ ಮಾಡೋಣ. ಅದರಲ್ಲಿ ಪ್ರಮುಖವಾಗಿ ಕ್ಲಾಸಿಫಿಕೇಷನ್ ಆಫ್ ಅಕೌಂಟ್ಸ್ classification of accounts. There are different systems, approaches are taken into consideration. Basically, accounts are classified into two approaches. One, traditional approach or English system, and modern approach, American system. First, we will discuss about the traditional approach, that is English system. In English system or a traditional approach, the accounts are classified into two broad sections. Firstly, personal accounts and impersonal accounts. Personal accounts includes the name of the person, name of the individual, name of the person, name of the company, name of the institution, name of the cooperative societies, name of the bank, name of the school, etc. It indicates any name, either it may be person name, or it may be institution name, or it may be firm's name, or it may be bank's name, or school name of any firm, any club, etc. In the personal accounts includes natural person, that we are all human beings, that name indicates name of the person, like Ram account, Santosh account, Vijay account, Manish account, A account, B account, C account, like that. It expresses only natural person. And artificial person. Artificial person indicates, that is, it indicates name of the institutions or body of individuals which are considered as person in the eyes of all. That is natural. Artificial person may be any institution or a firm or a club or a school or bank, etc. But it expresses in the name of the person in the eyes of law. That is two accounts. One, personal accounts include natural person and artificial person. All human beings are natural persons. Name indicates name of the person, male or female, whatever it may be, indicates natural. Artificial person is a personal account, but expressed in the eyes of law, name of the company, name of the institution, name of the bank, name of the firm, name of the club, etc. And second, impersonal accounts. Impersonal accounts includes two important branches. First one, real accounts. Real accounts, it indicates assets, all assets. Real accounts, all properties, all assets, all resources belongs to business as a real accounts. Now the real accounts again classified into two, tangible and intangible. Tangible accounts and intangible accounts. Tangible means assets which can be seen, which can be touched, which can be felt. There may be some physical existence. Physical existence like land, building, furniture, motor car, vehicles, etc. There we can see, we can touch, and we can felt. Those assets are tangible in nature. Intangible assets are those assets which cannot see, which cannot touch, which we cannot feel as assets, but in the eyes of law, but it is having some pecuniary values like goodwill, trademark, patent right, copyrights, etc. But there is no physical existence, but having some values, but treated as and recorded in the books of accounts, like goodwill, patent right, trademark, copyright, etc. or intangible assets. And third group, nominal accounts. Nominal accounts are accounts related to incomes, gains, expenses, and losses of business, called nominal accounts. Total all business transactions are recorded in the books of accounts based on the three important accounts. One is a personal account, real account, and nominal accounts. And while recording in the books of accounts, we consider three important steps. But to consider by every transaction, you should take any transaction having two accounts. One account is debited, another account is credited, same amount, same time, same date in the same books of accounts, but having different sides. One is debit, another one is credit. That, like that, which account is debited, which account is credited based on the rules. First, you have to follow three important steps. First step is find out which are the two accounts affected in the transactions. You can go through the analyze the transaction, go through the transaction, and find out two important accounts in the transaction. First, to analyze and find out the two accounts, just to take out two accounts from the transaction. After considering the two important accounts from the transaction, then which account is to be debited and which account is, these two accounts belongs to personal real, then you can apply the personal real nominal rules. This first account is a real account, second is a nominal account. For the real account, apply the rule for real, and nominal account, apply the rule for nominal account. Third step, apply the representative rules and decide which account is to be debited and which account is to be credited. Based on the rules, you have to follow certain rules and regulations while debiting, crediting, not according to your own views. You have to follow the accounting rules, regulation, principles. Based on the rules, based on the principles, the one account is debited, another account is to be credited. Based on, you have to follow three important steps. First step is analyze the transaction, go through the transaction, and just to consider two important accounts from the transaction. These two important accounts belongs to personal, real, nominal. Then apply the personal account. If it is a personal, then apply the personal account. If it is a real account, apply the rule of real account. If it is nominal account, apply the rule of nominal account based on the account, which account belongs to personal, real, nominal. Then application of the rules. These three important steps. But based on these steps, you consider the important rules of debit and credit. Personal account, debit the receiver and credit the giver. Real account, debit what comes in and credit what goes out. Nominal account, debit all expenses and losses and credit all incomes and gains. Like that, based on these are the three important rules according to traditional approach or English system. You have to follow, you have to go through the transaction. For example, purchase furniture of rupees 10,000 and paid cash. Purchase furniture rupees 10,000 and paid cash. Here, in case of purchase any furniture for cash, you consider two important accounts. One is furniture account. One is furniture account and cash account. Furniture account and cash. These two accounts, first to find out which account, first to find out two important accounts from the transaction. Purchased furniture of rupees 10,000 paid cash. But you can identify, analyze the transaction, find out two important accounts. One is a furniture account, another one is a cash account. Furniture account is a real account, cash account is a real account. Then second rule is find out which account, which class of the two belongs to personal, real, nominal. These two accounts, furniture account belongs to real account, cash account belongs to real accounts. Then for furniture, apply the rule of real account. For furniture, apply the debit what comes in, credit what goes out. While purchasing furniture, furniture is an asset, comes into business, then debit it. Debit what comes in, furniture comes into business, comes in, therefore debit it. Similarly, cash account is asset account, real account, cash account is also real account. For cash, apply the rule of cash, apply the rule of real account for cash. What is the rule of real account, debit what comes in and credit what goes out. Now whether cash comes in or cash goes out. While purchasing the furniture, cash comes in or cash goes out. Purchasing means furniture comes in. For that simultaneously cash goes out of the business. Cash goes out. What goes out? Cash goes out. Cash goes out. Cash goes out means what to do? Credit. Similarly, so many transactions are taken into consideration. But this is an example. Purchase furniture for cash, furniture account and cash account. Furniture and cash are real accounts. For furniture and cash, apply the rule of real. Real account rule is debit what comes in and credit what goes out. And furniture comes into business, furniture real account, furniture comes into business, therefore furniture account is to be debited. Similarly, cash account is a real account. Cash goes out from the business because while purchasing furniture, purchase means cash goes out to business. Cash account is a real account. Cash goes out. What goes out? Cash goes out from the business. Therefore, cash account is to be credited. This is one example I quoted. And next, and modern approach, that is American system. The accounts are classified into assets account, liabilities account, capital accounts, incomes and gains account, expenses and losses account. Same approach, same rules, same principles, but the method of presentation of the transaction, presentation in the books of accounts may be little different as per the modern approach as well as old traditional approach. Traditional approach and the modern, we will discuss later on the modern approach in my next class. Thank you.